mentioned at the top of the show that we had a great lineup for you today. And if you trade options, then you'll want to listen very carefully to our next presenter, who is a professional trader, registered investment advisor, and commodity trading advisor. He's an active trader of his own account. He also manages option-oriented accounts. He speaks on option strategies at many seminars around the world. He's perhaps best known as the author of Options as a Strategic Investment, the best-selling work on stock and index option strategies, which has sold over 300,000 copies. He's regularly quoted in publications such as the Wall Street Journal, Barron's, Technical Analysis of Stock and Commodities, Data Broadcasting Exchange Magazine, Futures Magazine, TheStreet.com, and Active Trader Magazine. Ladies and gentlemen, here to present McMillan's Market Outlook, what option indicators are saying now. It's always an honor to introduce Mr. Lawrence McMillan of McMillan Analysis Group. Welcome back to Traders Corner, Larry.
Thanks, Bob. Can you hear me okay?
Loud and clear.
All right, great. All right, so we're starting out a little bit late, but we'll see if maybe we finish here early.
Hey, feel free to run a few over because the previous presenter that did, sometimes I ask if you mind splitting the difference. If you finish early, so much the better. I'll send you a polite 5-ish minute reminder in the chat box.
No problem.
All right.
So we're going to discuss the current status of our indicators. It's interesting that we've just had a few new signals, but I would say overall the signals are still somewhat mixed. For those of you who are not familiar with our company, I started this company as a derivatives research firm in 1990. And originally we were doing publications, data research, that sort of thing. But then we had some success, or quite a bit of success, around the 2008 financial crisis. So we moved into money management at the request of some of our clients at that time. And we've always had some option education abilities. We have a mentoring program, and then we do seminars like this. So I will come back to this later, but we are offering a special and the ability to download the PDFs of this webinar if you go to that website, optionstrategist.com/MCM-web. So the four main indicators we're going to look at are these, although we have a couple of other ones I want to throw in there as well. First and foremost, the chart of the S&P 500. I mean, if you're predicting the market, you have to, be able to be in agreement with that chart. If your indicators are all bullish and the S&P is going down, then the S&P is really the right indicator. We'll also look at put-call ratios, a very interesting and important area of option analysis. We'll look at market breadth, where we have an option twist on that, and then of course the volatility indices, including the newest one-day VIX index. So I have an important rule that oversold does not mean buy. So we are, for example, have an oversold condition and some overbought conditions too, for that matter. But just because it's oversold, the market can still go down. So you need to get a confirmed buy signal. And the companion to that, of course, is overbought does not mean sell. So the market, when it's roaring to the upside, gets overbought, but that's not necessarily a sell signal either. So here's a longer term chart, a 2-year chart of the S&P. The main thing I think to take away from this chart is that we're in a bear market from January of 2022 right here. And the question is, are we still in a bear market here? Well, we've certainly run up against resistance here in this 4,200 level. You can see it there, then again there, and not even quite getting to it there. We've fallen back from there some. So there is an uptrend line here that's working, but to me, this is still neutral to bearish chart because of that resistance at 4,200. If we take a little bit closer look, a 1-year chart, you can see also that there's some pretty strong resistance up here at 4,300. This entire area inside this circle is what we call an island reversal. We gapped up into it, gapped back down out of it, and have not been able to fill those gaps ever since. So That's a major bearish signal when it occurs, and of course it led to this decline. But it's still hovering over the market there too. So even if we were to break out over 4,200, we still have to deal with this resistance here at 4,300. On the downside, we found support in December right around the 3760 level. That was the lowest level, but this entire area in here, 3850 down to 3760, that's a support area. If that were to give way, then we'd have some very negative outcomes after that. You can see that really starting in October, we've kind of just bounced around in this trading range between roughly 3,800 and 4,200, and we're still in that range. So we're getting mixed signals as we move around in that range, but eventually we will break out one side or the other, and that was when we will take a core position. So right now, we're looking at a close above 4,200 would be quite bullish, and a close below 39.50 would be bearish. Longer term, you brings in that 4,300 level I just showed you and the 37.60 level. But in between, you do have these strong oversold rallies in bear markets. So even though we're in a trading range right now, we're still getting some pretty violent movement. And as a result, we're not holding a core position at this time. We held a core bearish position for most of last year, but right now we're not holding that core. We're trading just the individual indicators as they occur. So in addition to just looking at the chart, we also do something with what we call the modified Bollinger Bands. And the reason they're modified is we use a slightly different definition of volatility. When John Bollinger invented Bollinger Bands, he defined volatility as the standard deviation of closing prices. Most of the mathematical guys, including Black and Scholes, and who invented the Black-Scholes model, use a slightly different definition, which is standard deviation of daily percentage price changes. So we use that definition here because our work really needs to be in line with Black-Scholes. Otherwise, the implied volatilities of the Black-Scholes model wouldn't line up with the realized volatilities that we're talking about. So in doing that, we noticed that these bands can be drawn around the S&P chart, and they produce some pretty decent buy and sell signals. So here's the current chart of this, and this top band here is using that modified definition of volatility. That's +4 standard deviations, and then the next one is +3. The downside is -4, -3. So when we move outside of the 4 standard deviation and then back inside, we get a signal. So here we moved outside and then back inside. That was a sell signal in early February. It was a good signal, came down, and when we touch the bottom band here, that completes the signal. It was followed almost immediately by a buy signal, which we're still operating under right now because we have not quite reached the +4 standard deviation band. However, we have positions that we took there, we've rolled them up, made some adjustments and that sort of thing. So we've taken some partial profits. But right now, the 4 standard deviation band is there, and the -4 is here. They've kind of tightened up some because realized volatility has declined in this market as we've moved sideways through this most recent trading range here through most of April. And we just now broken down on that on the downside, although today we're coming right back up into it. So in any case, these have been strong signals, and so we're still acting on that buy signal from March, even though it's a little bit aged at this point. And the we've had a long track record with this indicator in our daily strategist and option strategist newsletters. So we also offer this as a service, a separate service, where we look at these bands on any charts, stocks, futures, ETFs, that sort of thing. And we run that through tradingview.com. This is a picture of what it would look like. So this is the S&P 500. There's that buy signal that we're operating under now. There's the previous sell signal, and et cetera, et cetera. So you can see that it puts these little green and red arrows on the chart. This one here was a clunker. That was the blue B I had on the other chart, but the others have all been successful. And of course, not every indicator works every time, but you can see this is a sort of intermediate term indicator. It gives you a signal and then probably holds on to it for at least a couple of months or so. So the next thing we look at is put-call ratios, and put-call ratios were defined as an indicator by Marty Zweig way back in the 1950s when he was looking at put and call dealer volume in Barron's ads back then. Today, we use the equity-only put-call ratio as our predictor of the stock market, and equity only means that we're just looking at all equity options that trade, not futures or index options in this particular indicator. So Marty's theory was a contrary one. He noticed that if everyone was loading up on puts, the market tended to go higher. And if everyone was loading up on calls, the market tended to go lower. And it's still the case today. The trick is to define what's too much put buying, too much call buying. So just as a simple example, suppose we look at IBM at the end of the day, we sum up the volume of all the puts that traded. Separately, we sum up the volume of all the calls that traded, divide the two, that's the put-call ratio. So since our puts are in the numerator of this fraction, a heavy put buying will make the ratio go higher. But when are you likely to have heavy put buying? Well, that's when the stock is going lower, right? So the crowd, follows the stock path. Same thing with call buying. Since that's in the denominator of the fraction, heavy call buying will force the ratio to go lower as the denominator increases. But when are you likely to have heavy call buying? Well, that's when the stock is going higher. So the basic thing here is that the put call ratio moves opposite to the stock price. We keep a moving average, generally 21-day moving average in this indicator. So typically, in theory, anyways, this is what we'd like to see. We publish about 1,650 put call ratio charts on our website every day in an area called the strategy zone. And what you would want to look for in any of those charts is we publish the stock price along with the ratio, and you want to see them have this inverse relationship. In other words, suppose the stock is declining. And as that's happening, people are buying puts, forcing the put-call ratio higher. Eventually, the put-call ratio forms a local maximum, tops out. And that is a buy signal for the stock. Then after that, the stock starts to increase and value. Move over to the left here, so stock is increasing. When that's happening, people are buying calls, forcing the put-call ratio lower. Eventually, you get to a local minimum on the put-call ratio chart, and that's a sell signal for the stock. So that's the theory. If you're looking at a chart and it doesn't adhere to that, then perhaps some other sort of thing is going on there, including arbitrage or other, distortions that take place. And so I always check out both the put-call ratios and the stock chart, hoping not only to see this inverse relationship, but to see that the signals have been working. So this is a chart, not a current one, but on the top is the S&P 500, and on the bottom is this equity-only put-call ratio that I talked about. You can see most of the time this inverse symmetry exists quite visibly, and so that's why we use the equity-only put-call ratio to predict the broad stock market. So here's the current equity-only put-call ratio going back for about a year, and you can see that there have been a number of local maximums here on this chart. Those have all been pretty decent buy signals. And as we pointed out before, this market's been in the trading range. Then we come down off of those and we form local minimums. We get sell signals. So what just happened is we just got a brand new sell signal, really confirmed as of yesterday. So this will be in effect now until the ratio turns back over at some point and makes a local maximum again. So this sell signal is in effect. I don't know if we're going to come all the way back up to here, which we've done the last 3 times, but it seems like that's certainly possible. Now, as computers came along, we were able to calculate another put-call ratio, this one using option prices and not just option volume. So we calculate for each particular option. At the end of the day, we multiply the option's price times the volume traded that day, and that gives us the dollar volume. Now, you could do that on a tick-by-tick basis, but we are just using on a closing basis. It turns out, at least with our analysis, to be very similar. So we make this calculation, let's say at the end of the day for each IBM option, we sum up all the those dollar volumes for all the puts, and then separately we sum them up for all the calls, divide the two, and now what you've got is the weighted put call ratio, or dollar weighted put call ratio. In a sense, essentially you're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. And that turns out to be, gives you signals at about the same time, but they can be more extreme. So you see, for example, that we had some really extreme selling, generating a lot of put buying and creating these high ratios back here in last October and again in January. So those two rallies were very strong. Now, we did get a local maximum here again in mid-March, but it was much lower on the chart. And typically that leads to a less strong rally, but it certainly was not a bad rally. And now we've just again come down and made a new local minimum, and you can see this local minimum is down here at the very bottom of the chart, meaning there's been some heavy optimism forcing, the call buying has forced the ratios to very low levels, and those are typically the better signals. So we just got a new sell signal here on this chart as well. So very little else to say there, except that historically these are very strong signals, and we have a long and profitable track record in the Option Strategist newsletter, which you can look at the results of our trades there on our website. So what do we buy when we have a signal, a put call ratio signal or the MVB signal or any of these things? So primarily we want to buy an option that's going to respond with the underlying movement, the underlying in this case being the S&P 500 or SPY. We're usually trading SPY options. And so the delta of a call option ranges between 0 and 1, indicating its percentage movement along with the stock. So if it's 0, the stock goes up and the option isn't even moving. Those are typically very far out of the money options, or ones that are about to expire out of the money. On the other hand, a deeply in the money option will have a delta of 1. In other words, it tracks right with the stock. So we want to buy an option that has a fairly high delta. You don't necessarily need 1, but we want to, I don't want to be wrong on the option and right on the stock, on the underlying. If I'm predicting the underlying, which is what I'm attempting to do with these put call ratios, then I want to make sure that the option I choose is going to move along with it. So we buy an in the money option, typically with a delta of about 0.70 or higher. That's 1 or 2 strikes in the money, usually a month or so out. If we're using a little longer term thing, say a longer term put call ratio, then I might buy an at the money option. But even an at the money option has a delta that's greater than 0.5. And so that's going to move along with the stock quite well also. So you see on TV a lot of times the option shows or whatever, they're using spreads all the time. By a spread, I mean you buy, if you're bullish on the stock, you buy a call at a low strike, and then you also sell a call at a higher strike. What that produces is this profit picture. In other words, you have limited risk because you can't lose more than what you spent. And then in between the 2 strikes, you make money. But as soon as you get to the higher strike, that caps off your profit. Well, that's a pretty devastating thing to do to yourself, to cap off the profit like that. In fact, statistically, it only makes sense to do that if implied volatility is very high. If it's average or low, and we publish a lot of implied volatility statistics on our website, including a comprehensive free volatility file every Saturday. But paying customers can see that information every day. So what we're really looking at is a comparison between this red line, which is the call purchase, and the black line, which is the bear spread. So why would you want to cut off your profit potential? Well, typically the proponents of using the spread will say, well, you're risking less, but that's a fallacy. You're risking 100% of what your broker requires you to put up to buy these positions. So if you buy a call, you have to pay for it in cash. You're risking that all, or you're risking all of that. So if you buy a bull spread, again, cash, the difference between what you paid for the call on the low side and what you receive for the call on the higher strike. So if you lose, you lose 100%. So if you're trying to balance dollars, well, then just instead of buying, let's say, 5 bull spreads, buy 4 calls or something like that. But the risk is also always 100%. And of course, your profits are much greater if you don't cut off your upside. Now, if you do use a spread, there are some things you can do to help mitigate the problems. One is to spread the 2 strikes farther apart. And we do that with our SPY positions. In calls, we typically spread the strikes 15 to 20 points apart. With puts, since puts are more expensive than calls on a relative basis for SPY options, we spread the strikes farther apart. So I said what we just had a new sell signal, so we were spreading this. We did a June spread, a little more than a month out. And we spread the strikes 30 points apart. In addition, you can mitigate further the problems of the spread if you used one, if you roll when the short strike is hit. So let's take this example. Suppose SPY was 397 and you put on a SPY call spread 397, 412. I see that that says Feb. It should say May as it does on the next chart. On the next chart was the May spread we bought, and now the SPY rallies to 412. So now you've reached your upper strike. From here on, you're not going to make much more money on the upside. So you sell that spread and you buy a new one, assuming that you still want to be in a spread. And again, you keep the expiration the same. You keep your striking price distance the same, but now you've moved higher. So you took a profit on the first one, and now you're in the second one. And again, you can continue to do that over and over, and as long as the upper strike keeps getting hit. Anyways, let's look at a couple of individual put-call ratio charts. These are, we do recommendations on stocks, indices, futures, etc. These are just a couple of recent ones. This was Honeywell, and Honeywell is, well, any of these stocks are individual put-call ratio charts. We only use the more extreme signals. So this one in the middle here, we didn't really use that. This one in the middle, we don't really use that. Even this one, we're looking for the extremes. The extremes we define on a percentage basis. But in this case, we had a buy signal here, which was modestly successful. This one was a little better. This one was even better. And now we've got a new one just here recently, a couple of weeks ago. On the downside, the extreme signals were this sell signal here, which was did pretty well, and then this sell signal here, which also did pretty well over a longer period of time. But right now, we're in a buy signal in Honeywell. Similarly, NASDAQ, the NASDAQ company, NDAQ, had a recent buy signal here as well, just around the 1st of April. And what we do on many of these cases is we look for a breakout over a technical level, which we got there as well. And we can do the similar thing with futures options. In this particular case, the put-call ratio chart down here is drawn using corn options that are traded on the Chicago Board of Trade. And so that gives us our local maximum, local minimum, etc. We just recently had a local maximum there, so that was a buy signal. And this chart here is the continuous chart of corn futures. But if you don't have a futures account, or even if you do, in many cases, there's an ETF that trades that has that tracks the price of the future. In this case, there's an ETF, CORN, which is corn, of course, and it tracks the price of corn. So we're long options on corn, the ETF, and not long options on corn futures on the Board of Trade. Obviously, you can trade either one, but a lot more people have regular stock accounts, so you can trade the corn option, CORN, rather than the futures options. The next indicator we look at is market breadth, and this is simply the advances minus declines on any day. There's a couple of things you can do with that. One is you can keep a cumulative total, which is modestly useful, but typically really only comes into play after a long bull markets. Or you can keep an oscillator, which is much more useful on a day-to-day basis. So the oscillator we define is defined this way. Our oscillator value today is 90% of yesterday's oscillator value plus 10% of today's advances minus declines. Now, the problem becomes a little bit more complex when we consider the fact that, that New York Stock Exchange advance decline data is the typical mainstream advances minus decline. The problem is that there's things that are on the New York Stock Exchange contributing to the number of advances and declines, which are not stocks. So we want to also look at what we call the stocks only data. And we realized a number of years ago, more than 20 years ago actually, that we had a great data set here right under our noses, and that is all stocks that have listed options. Nowadays, there's almost 6,000 of those. It might even be more than 6,000 now. So that's a pretty strong data set. And it includes, of course, large caps, small caps, over-the-counter, New York stocks, everything. And they're all stocks. So this is the oscillator value going back to 2013, so 10 years actually. What we define here is if the oscillator falls below minus 400, it's oversold. And if it rises above plus 200, it's overbought. Well, for 9 years of those 10, we were in a pretty much a big, long bull market, so we didn't get oversold too often. We did here, this was 2018, right around Christmas time. Of course, this was the pandemic in March of 2020. But then last year, we entered the bear market, so we started to get oversold much more often. Now, as I said at the beginning, oversold does not mean buy. We wait for it to stop being oversold, say here, before we buy. So we had a sell signal here in April as we came out of an overbought condition, and now we're oversold. I haven't really looked at breadth too closely today, but if it pulls it back up above the minus 400, that would give us a buy signal on the breadth oscillator. So this is one oversold indicator that we have right now. It has not confirmed a buy signal yet, but it eventually will. It can't just hang around down here forever. So when it moves back above minus 400, that will give us a buy signal from this indicator. So this just sort of summarizes that, pretty much everything I just said. We have that sell signal there, we operated on that, and now we're oversold and we're looking to get a buy signal somewhere in the near future, perhaps even today. Another thing we'll look at is new highs versus new lows. This doesn't really have much to do with options, except for the fact that we do over 3 data sets. So we look at New York Stock Exchange data, which is the first 3 columns. We also look at stocks only data, that's our optional stocks. And then since it's published in the news, in the newspaper, well, not the newspaper, but online in the data sets, NASDAQ data. So you can see here that just the last couple of days on New York data, we started to see more new lows than new highs, and by enough of a margin that there are more than 100 new lows than new highs. So that is a sell signal. You can see, though, that these other data sets have been much more negative for a while now. So even though the market itself was up around the highs of this trading range recently, mid-April, new highs, new lows were not sharing in that, that optimism. We're seeing a lot more stocks making new lows than you might expect, with the market making a new, well, essentially new to the relative high for the year. Finally, we look at VIX and the VIX tradable securities around VIX, and we have several indicators built into that as well. These, I will tell you right now, are mostly positive and have been for a while. But the first indicator that we look at is the trend of VIX. So whichever way the VIX is trending, most of the time the stock market will trend in the opposite direction. So that's an important indicator. Number 2, we look for spike peaks in VIX where it comes up, spikes up and back down again. Those are typically buy signals for the stock market as well. And occasionally we get the situations where VIX is quite low. It's debatable here recently when VIX got to 17, is that low or not? We'll talk a little bit more about that in a minute. But back in, like, say, 2020, or even 2019 more likely, VIX was all the way down to 14, even sometimes 12. And so that is an overbought condition. But as we've always said all the way along here, overbought conditions are not sell signals. You have to wait for VIX to rise before you actually get a sell signal. So here's the current chart of VIX going back about a year. And all these B's on here are spike peak buy signals. So the red letters are successful ones. We had a nice one here in mid-March where we caught the lows pretty well. And these signals last for a month. So that signal has terminated and has ended profitably. The previous one to that was last October, and that ended well too. However, right before that, we had a few false signals. So the false signals are marked here with blue letters. So overall, I can tell you, going back over a long period of time, these spike peak signals are quite successful in the aggregate. And we have not had one here yet, even though that looks like it might be a spike by the definition that we use for this system. That is not yet a buy signal. Then we have, so I said also, so that's one signal. The other is the trend of VIX. And the trend of VIX is defined by where the 20-day moving average is and VIX, those are VIX bars, with respect to the 200-day moving average. If both VIX and the 20-day moving average are below the 200-day, that's a trend of VIX buy signal. So we got a buy signal right there. In March, when VIX moved up here, that terminated that buy signal, but then it became back into existence right there, and we're still on that trend of VIX buy signal, and we will be on that until VIX closes above the 200-day, which is up here at 23. That's probably, that might happen, but to get the 20-day all the way up there, that's going to be a chore. So this is a bullish indicator back right now. So people have been saying, well, what, VIX is 17, is that too low? But you have to understand, realized volatility has dropped a lot in this market. So we look at the 20-day historical volatility of SPX, which we call HV20. HV20 got all the way down, well, less than 10, and VIX was 17. That's a big difference. And VIX can't really go much lower with realized volatility being all the way down there. So VIX can't go much higher with realized volatility being all the way down there. So this has begun to increase. We'll see if this increases as well. Another thing that's important, you can't trade VIX, but you can trade VIX futures, of course, and VIX options, which are based on the futures. So in this particular market, we're in a bullish situation. In other words, if we look at the term structure of the VIX futures, when they slope upwards as we go out in time like this, that's bullish for the stock market. In a bearish market, like we most certainly had in March of 2020, the term structure of the VIX futures slopes downwards, and that's bearish. So I said, right now we're in a bullish state. This is actually prices I took from right about noon today. And at that time, VIX was 1736. The closest term future was the May futures, 1925. So 1925 minus 1736 is $1.89. So they were trading at a premium. And you can see if we look out the futures here, they're going up, sloping upwards out to about here, and it kind of flattens out after that. So the term structure slopes upwards in the front end, and that's modestly bullish. And all the futures are trading at a big fat premium to VIX because that's, as I said before, realized volatility is much lower than historic, and so than VIX. And so we have a upward sloping term structure with positive premium on the VIX futures, and that's all bullish for stocks. The CBOE publishes now 6 volatility indices, used to be 5, but now they've added a new one, the one-day volatility index. The symbol is VIX1D, one day. And you can see how these stand. So typically, a one-day volatility is going to be lower than anything else, even though it seems like market's crazy over one-day periods, and people have been all excited about the 0-day to expiration or one-day to expiration options. But you can see here the term structure pretty much slopes upwards, except for this. The 9-day volatility index is higher than the 30-day, which is VIX. Why is that? Well, we have the FOMC meeting next week, and also unemployment figures coming out on the first Friday of the month, which is next week. So that's all within the 9 trading day look forward period. And so some volatility is built into those options because of that volatility. Those events could be volatile, but again, mostly bullish, mostly sloping upwards. And so the term structure and all these VIX indices right now are pretty much staying bullish for stocks. If volatility were to begin to increase here, then we would start to get sell signals. That doesn't seem too likely from this set of indicators right now. But the number one thing we watch for in that regard is we watch the front month futures versus the second month. And the front month is now May, as you saw in the previous chart, trading at 1925. Second month is June, trading at a big whopping premium over May. If May were to rise above June, that would be a dangerous sign. But right now, no danger at all from this what we call term structure or volatility construct. So in many years when we had flash crashes or pandemic 1 month crashes or anything, we would get these term structure inversion sell signals. That did not really happen during the bear market of 2022 to 2023. And as a result, some people are saying, well, the market's not working right, but it is. It's just that a slow grinding bear market doesn't really have the volatility of a crash. So here's a summary of the indicators. You can see on the plus side, we've got that McMillan's volatility band that we talked about earlier, and then the volatility VIX indices. On the negative side, well, the chart of SPX isn't really so bearish, it's just neutral with that trading range, but we have sell signals from the breadth oscillator that might reverse soon. And then we do have a new sell signal from new highs versus new lows, and a new sell signal here. So bottom line, the signals are mixed, and we trade them individually as they occur. We are not trading a core position at this time. I'm going to really need to see this market break out over 4,200 or probably below 3760 before I take on a core position, which means we take an aggressive position in that direction and then trade other signals around it. Just one quick thing here. There has been a realized volatility sell signal. As I said, the historical volatility of SPX fell low and now it's risen back up a bit. The crucial level is 10. We haven't had a signal from this indicator since late 2021. We had one there was stopped out, had another one stopped out, but then we had the very important one there in December of that's 2021, which preceded the entire bear market that unfolded. Now we just got another one. The historical volatility dropped here and went back above. That's a sell signal unless it falls back down here again. So we'll see, but this is a sell signal for historical volatility. Implied volatility, meaning VIX has not joined in with that yet. I mentioned we are offering this special offer here. It's pretty simple. You can go to this URL and download the PDFs of today's webinar. And what you'll get in that, the special is a 6-month subscription to the Option Strategist, which comes out every week. You'll get the 14-part intensive home study course. Each of those is about an hour and a half in length. They were all recorded within the last year or two. And then you get a copy of the Bible Options as a Strategic Investment, and also consultation regarding money management. So we do have other newsletters. We have a YouTube channel if you're interested. Visit our website, take a look at those things, or search for us on YouTube. And just one final chart. This is the 73-74 bear market, which I think the current bear market resembles. We started out from an all-time high. We came down for a while. We had a pretty good rally. Then we went back down, and it messed around for a while in a trading range. Eventually, it broke down when Nixon resigned, and we had a very bad drop during the fall into an October low, and that ended that bear market. So where are we on this chart? I think we're about right there. We're somewhere in that trading range area. You know, what could force us out on the downside? I'm not 100% sure. You never really know, but it certainly has something to do with the debt ceiling, further tightening of interest rates, etc. Anyway, that's our information there. If you're interested in our money management, that's a URL to go to for that as well. So let me turn it back to you. I'm just a couple minutes over.
Hey, thanks so much, Larry. As always, that was incredibly valuable information. Ladies and gentlemen, that was Mr. Lawrence McMillan of McMillan Analysis Group. And as William pointed out, we refer to Larry as the E.F. Hutton of options traders here on Traders Corner, because when he is speaking options, it is a real good idea to listen. I guarantee that you will learn something. Keep up the great work, Larry. I was waiting all day to listen to your perspective on the current environment. And let me tell you, I've been agreeing and profiting from the fall the last few days.
Okay, thank you.
Hey, please come back and see us again. You can
Will
find
do.
Larry at optionstrategist.com. I did put his link in the chat. I see he did as well. Have a great weekend, Larry.
All right.